Awesome. Well, Aashner, do you want to kind of kick off?
Yeah, absolutely. I think hello, first of all, to the audience that has joined us today. We're so excited to provide our VC perspective on how to find your fit in venture as a young tech professional, from the perspective of someone who maybe has an idea and wants to seek funding for it. We're going to go through 4 sections in this conversation. I'll take the first 2, and then my partner Amani will take the second 2. And before we jump in, I think a great thing for us to do is quickly introduce ourselves. So speaking for myself first, I'm a venture capitalist at Generation Ventures. We primarily invest in Series A and B, B2B SaaS, but we'll be opportunistic and look from seed all the way to growth. And we're also a limited partner in a number of funds, all the way from up and coming incubators to household name venture and growth equity firms. And then outside of the work that I do with Generation Ventures, I run the Toronto branch of Startup Boost, which is a not-for-profit dedicated to providing free boot camps to cohorts of early stage founders with workshops, mentorship, and speaker sessions.
For everyone who's topic. I'm Amani Phipps, I'm a VC with RareBreed Ventures. We're an emerging pre-seed venture fund based out of Baltimore, but focused on investing outside venture tech hubs. Additively acts as a venture partner with Republic, the crowd equity platform, and lead RareBreed Ventures is focused on inclusive founders, ecosystem, while additively helping diverse founders be paired with diverse corporate board talent as well. Prior founder, turn funder, and have kind of worked through the entire circle, right, of this ecosystem from the perspective of a founder all the way through seeing the LP's world. So have a pretty holistic vantage point here, and really look forward to being able to dive in. But I guess with that, we'll go ahead and get things going. And Aashner will lead off with the overview of the venture ecosystem.
That's right. Happy to speak to a little bit, starting with the venture ecosystem, beginning first with what the value chain looks like in terms of funding, all the way to you guys. So usually this starts with a limited partner, which is a wealthy individual, corporation, or general organization of folks who want to dedicate or allocate funding to tech businesses, but don't necessarily have the wherewithal to do that on their own. So they'll usually commit funding to an investor. This would be anything from an angel group, syndicate, to general venture capital fund, all the way to private equity, folks who are experienced and knowledgeable in allocating funding to the best and brightest up and coming startups, which are led by then founders, you guys. You guys use those funds to advance and accelerate your businesses and create an appreciation and value in the companies that are being invested in. That value appreciation not only goes to the founders, but then also comes back up to the investors, which then in turn comes back up to the limited partners. So maybe we call this a value chain, but really it's more like a cycle of funding that then just kind of goes round and round between these 3 parties. But if we could go to the next slide, today what we really want to focus on are the different types of early stage investors, and what are the best ways to know if you are the right fit for each of these, and where it makes sense to start approaching them. So usually the first stage is, if we could go to the next slide, the angels and friends and family stage. This is when you need funding to build your minimum viable product. These are folks who will put their trust in you at an idea stage and help you flesh out that idea to create something tangible and real. These can range anywhere from individual wealthy folks who can do checks of 20,000 and up, or syndicates of angels who are wealthy individuals who come together to evaluate and then invest in tech startups as a team, that are usually unified by things like the geography that they're based in, their school alma mater, or any other variety of social grouping. They'll look at businesses like yours, figure out whether or not they're the right people to help. And then if they do put in money, usually it's a check of at least $100,000. And angels will typically offer their time as well, whether that be introductions strategically to potential commercial partnerships, right? Folks like co-founders to help you get your feet on the ground, or later stage investors. So moving past friends and family or angels, where do you go next? At this point, usually you have some sort of minimum viable product. So something that you would like to start selling, something you would like to start monetizing. And this is where accelerators really come into play. So the terms in which an accelerator provides funding to founders typically varies very drastically depending on the actual accelerator and their programming. So for example, with Startup Boost, we don't charge any fees, we don't take any equity, and we don't take any ownership in the businesses. So when you're approaching an accelerator, it's definitely important to understand what you're really going to be getting out of it in terms of a monetary incentive. But beyond this, what accelerators provide are literally tools to help you accelerate your business, whether that be partnering with domain experts to help you refine your product, pitch workshops, mentorship, commercial introductions, and oftentimes promotion and showcasing to the broader investment community to make sure that you're set up as well as possible to get funding for the next stage in your life cycle. And for a lot of folks, next slide, that next stage is the seed fund. We've also seen a lot of pre-seed funds, which are for folks that are earlier than this. And these funders are usually the next step either way from an accelerator. So a typical seed round right now is where you are completely launched as a product. You're starting to make quite a bit of money off of it, usually under $1 million a year. And you're looking for a round that'll provide you with a year and a half or more of funding. Usually this round is $1 to $3 million. And it's usually raised by either one or a number of seed funds. So you will have one regardless that is going to be a lead investor for you. They'll invest the bulk of the size of your round, and they are likely to assume a board position where they'll help you with strategic introductions or literally getting their hands dirty and helping you with building out your product or financial model or figuring out a go-to-market strategy. But really, the value add that a seed investor brings beyond capital is so specific to the ethos of that fund. So when you're thinking about the right fund to partner with, it's good to learn about them just as much as they're learning about you. Seed investors are typically the ones who will make the introduction to the fund that will be the lead for your next round, which is Series A, if we could go to the next slide. So once you reach Series A and more, you've usually achieved some sort of floor of at least $1 million in revenue for the last 12 months or $1 million in recurring revenue today. So you have a real product, you've achieved product market fit, and now it's about how to achieve that scaling up process. So the Series A fund will usually come in at this point. They'll help you a little bit more on that go-to-market strategy, assuming that a lot of the kinks in the product have been really fleshed out. Usually, like a seed fund, the Series A will assume a seat on the board and help you in a really hands-on way. But again, it's always super valuable to make sure that you understand the ethos of a fund when they're walking into a relationship with you. And I think the other thing to consider with your Series A is that you're going to want enough runway from this raise to usually achieve something like $5 million before getting your next financing, which would be a Series B and onward. But here we're kind of just focusing on early stage. So that's kind of an overview of some of the paths of funding that you can take in the venture ecosystem. The next thing that we want to quickly cover is part 2 of this presentation, which is how do you really position yourself so that you're targeting your pitch for early stage investors. We're not going to teach you how to do a pitch here, but we're going to talk about some of the key metrics that early stage investors, regardless of stage, really value. Starting with your problem statement. This is the so what. So problems can be defined as issues that would be nice to be solved or absolutely need to be solved. From the perspective of an early stage investor, they're really looking at how critical and how urgent is the issue that your problem is fixing for your target market. So when you come in with a pitch, you need to really be able to express, often using research or figures, why this is a need to have. And the next piece that's critical is your value proposition. This is, how are you solving this critical problem? How are you directly addressing the pain points that you made clear are really important to be addressing? And why do you uniquely solve it? This is where, as an investor, I want to understand, okay, I understand that there's an issue here, and this is one way to fix it. But why is this the issue? And why is this the solution to solve the problem? It might be years of expertise in the space. It might be a number of patents or some sort of go-to-market expertise. But this is really where you share your secret sauce in your product. The next thing that you want to consider is the proof. So I can sit here and tell you that I have the best fashion sense in the world, but it doesn't mean anything unless people are actually stopping me on the street and asking me where I got my purse. This is a sign of validation for traction in a business. And there's a number of different ways to quantify this, regardless of what stage you're at. As an early stage investor, often one of the key ways to see that there's been validation or traction, proving that your product works, is growth. So thinking about growth in revenue, ARR, number of users or customers, any sign to show that this is really picking up. But it's not enough just to have growth in the business. You need to be able to satisfy your customers because they can come just as quickly as they leave. For example, think about Quibi. That business exploded when it came out with a 3-month trial, and now it's out of business after less than a year. So you want to be thinking about things like customer retention. Are people continuing to use your product and repurchase from you time after time? Are they referring you to other customers? If this is a contract business, are people increasing their contract size with you over time? These are all signs that it's a great investment, and these are key metrics that early stage investors are looking at. If you're really early and don't have any customers at the time, it's worth sharing who you're talking to right now. What does your pipeline look like in terms of the customer names and dollar sizes? And who are you in pilots with right now? These are the folks that are most likely to become customers down the road. And then finally, recognition is always valuable. Are you winning any awards in your field? Are there white papers around the technology that you're developing? These are all signs to show that your value proposition works. Next piece that we want to talk about is market size. This is what we like to think of as early stage investors as the art of the possible. Say you're Uber, you want to disrupt the taxi industry, and I was an early stage investor in Uber, which I'm not, but I wish I was. I would be thinking about the entire size of the taxi industry, and that would be the art of the possible for a company like Uber. So there's 3 different ways to think about what your market size is in a pie that's always dynamic. Your total addressable market is if you owned 100% of the market, there's no competitors, and every single person who could possibly buy your product did buy your product. So say that I developed an Xbox game. My total addressable market would be the price that I would be charging for the game multiplied by every single household in the world that has an Xbox. Next is the serviceable available market. So this is being more refined. So you know that you're not going to be able to get every single person in the market, but who is actually reachable for you? So say that my Xbox game in the last example is in French. Now you want to think about how many French-speaking households have an Xbox. Multiply that by your sales price to get your serviceable available market. And then finally, you want to think about your serviceable obtainable market. And this is backed by research, customer introductions, thoughts around competition, pricing, to think about realistically, what percentage of the market can you truly capture? So going back to that Xbox idea, say if I knew I could only capture 10% of the market, I would take that and multiply it again by my sale price. It's really important to note that this is ever changing. And if you're pitching to an early stage investor, that investor wants to understand what are pathways to increase this market size in the future and extract more value from the business. So if I was pitching my Xbox game to an investor, I would say, we would like to use these funds to translate our game into English. You know that will then increase your market size. And then the next piece that's really valuable for any early stage investor is competition. If there's no competition for what you're trying to develop, probably not a good business. There's always someone who's offering some sort of similar solution, and an early stage investor understands that. But what we want to understand as well is what makes you unique and different. And it's really valuable to tie this directly back to the pain points that you address in your problem statement. So a great way to address this when you're speaking to an early stage investor is sometimes even just in a chart form, putting yourself side by side against incumbents in the market, rising stars, or potential new entrants that could pivot into your market, and really going into detail about how you're differentiated on all of the key pain points that your target market faces. So some key differentiators that I see a lot as an early stage investor are things like key resources, IP, and speed to market. These are all ways to show that you have a clear competitive advantage and a differentiator in an environment that might have more players than you. And then finally, one of the most important pieces that an investor thinks about is the team. So this is not the time to be humble. It's the time to show why you're the right people to execute on your strategy and take your business to new heights. This is where you really want to dive into this founder story. An early stage investor wants to be inspired and understand what drove you to something. Oftentimes, you don't want to say you started this business because you wanted to make a lot of money out of it. There needs to be a driver that shows that you're in it, that you understand the problem, and you're going to be in it for the long haul as well. And your whole team is too. You also want to show off your achievements. As an early stage investor, I want to understand the qualifications that you have in your specific domain that make you the right team to execute on this strategy. Say if I had a PhD in game design, I don't know if that exists, but if I did, that would make me particularly suited to develop an Xbox game. And then it's always valuable to share your champions. Often cases when you're approaching an early stage investor, these might be the first people that backed you, maybe the angels that backed you. This is a great place to show that people who are on your side are knowledgeable and skilled in understanding the space. So great place to talk about backers, advisors, or anyone else on your way who's just cheering you on. And next we want to talk not just about what they're looking for in you, but what you should be looking for in investors. And I'll pass it along to Amani to talk about that.
Yeah, no, so thank you for passing that along. I think it's a really great overview of the entirety of the ecosystem. So now I want to really focus on finding the right investor. So as described, right, there's a number of different partners, a number of different stages in which venture firms exist and individuals whom can deploy capital into your company, right? And I think when looking at the venture ecosystem, one of the first questions that you do have to ask yourself is your business model best suited for the venture ecosystem? And I think that's a really important thing to understand. So when we go back to that value chain, right? LPs are deploying capital into investors of a variety of types, right? Those investors are then deploying that capital into founders with the expectation that they can generate enough of a return to then provide a 2x, 3x, right, 4x return on the entirety of the fund for those LPs. And that requires a growth rate, right? For some VCs, they look at, they need companies to 10x, 20x, 30x, 50x, right? They need to see unicorns, they need to see decacorns, right? To be able to kind of generate these returns with the traditionally high failure rate of some founders, right? And I think that's a really important thing to keep in context. Of failure is subjective to what fund returns need to actually look like. And just because you're not a venture-backed company does not mean you're not a good company. And just because you've raised a bunch of money via venture does not also mean that you're far more successful, because successes should be predicated off profitability and revenue. Capital raised, right, is another portion there. So I think this is a really important thing to set the stage for targeting the right partner, especially at the right time. So that very first step, right, is identifying an investor at the intersection of the stage and sector that fits within your, right? Are you pre-revenue? Are you pre-product? Are you looking for an investor that has channel partnerships? What type of business model are you operating under? Are you enterprise SaaS? Are you hardware? Are you just purely software? Are you B2B or B2C? These are a lot of the questions that you need to continuously evaluate, right? And then find that best suited fit. Maybe an accelerator is going to be a phenomenal option for you to generate some capital for you to kind of put together your MVP, and then be far better tailored to generate some traction, get some pilots, and then find the right seed stage investor. Maybe you're on the West Coast, right? And you need to identify an angel group that has some really strong ties and connections. And this is the upside about angels. Angels, like none other, particularly angel groups, have domain expertise specifically with the geographic region, right? You can go to the Angel Capital Association and identify groups of angels in any particular space, but oftentimes those groups of angels have been working in those ecosystems in that geography for decades at this point in time. They have channel partnerships, they have capital, they have knowledge, right? And they can really help in accelerating the business within that space while additively looking for smaller returns. But I do think it is really important to identify that right investor, because that also raises your chances of getting to that next meeting and getting capital. a lot of times in this entire ecosystem, what we find is that, VCs will traditionally know 5 to 30% of those companies are oftentimes off thesis. And if you're not looking at the right partner predicated off of, again, that ethos, the scope of investment, the stage in which your company exists, you oftentimes might make it substantially more difficult for you to get the opportunity to raise capital solely because, right, that's something that just doesn't fit within the scope of investment there, right? So I think it's additively important to understand, well, what is it that you need? Do you need channel partnerships? Do you need, purely capital? Do you need a firm with expertise in your domain to have somebody sit on your board as well, right? Answering those questions will best align yourself with the type of investors that you need to find yourself with. And it moves into strategic investors, right? Strategic investors can be traditional VCs, right? We see traditional and corporate VCs. Corporate VCs are just corporations who to invest. It's really strategic and it makes sense within kind of the scope of work that they actually do. But you additively have strategic investors on the traditional side, whereas you might see a strategic investor being a edtech focused fund. They only do edtech and they have a lot of connections with the Department of Education. They have a lot of connections with colleges and institutions across the board. They could be really strategic investors to help you make the channel partnerships that you're going to need downstream to additively then, right, create revenue opportunities, grow and excel a business, and then prepare you for up round capital, right? And just continuously raising for that next round. Another side of that is particular with corporate investors and corporate venture funds. And something that's really unique here, a lot of times, whether it be if you have a SaaS product in fintech and you're somebody like Plaid was, right, or Stripe, right? Having a strategic investor that comes in, and maybe it's JP Morgan's venture fund. If they then deploy capital in you, and a lot of these strategic investors traditionally for the corporate side have accelerators, and then they will likely choose from their accelerators companies to actually invest in. And the companies that they actually invest in, often what you'll see is 3, 4, 5 years down the line, get them additively, if you find yourself as a direct to consumer product and you need particularly retail exposure and access, maybe an individual like Target's Accelerator, right, is a really interesting play, right? If you're in the beauty space, Estee Lauder or L'Oreal, right? They make strategic investments and then additively follow those up with sometimes billion-dollar acquisitions if it seems to have some market expertise and domain experience that they haven't necessarily reached out to, so they can capture that new audience, right? So I think thinking long-term as well as where do you want your business to go? Do you want to go IPO? Do you want to be a unicorn? Do you want to just get to a liquidity event? Keeping those things in consideration are really important because it gives you the huge opportunity for some amazing go-to-market partnerships, situating customer contracts, and again, right, being acquirers downstream. But additive to keep in consideration, when looking at corporate venture fund, you traditionally have longer diligence cycles. This might take 2, 3, sometimes even 4 months. From other sides, in early stage investors, you might have shorter diligence models. And again, it really goes back to identifying investors who fit within your ethos and personally, morally that you find that you can align with. Because they say here in this ecosystem, making an investment is kind of like a marriage, right? And you have to be really considerate of the investors that you want to have on your cap table, because you can find investors who either one, give you predatory valuations and take a large amount of your equity, and especially raising in this venture ecosystem, each raise, you're losing a lot of equity. And we've seen in this space, you might get founders who IPO, but only end up having 5 to 6% of their company when the company goes to IPO. So keeping those things in consideration as well. Additively, you might find investors who call you once a week, or every other week or twice a month, like, hey, where's the money, right? When are you going to get to $100 million ARR, right? So keeping those things in consideration and finding investors that you can relate to, finding investors that respect you, you can respect them and you can have a mutually beneficial, but more so respectable relationship, because this is long-term, right? Traditionally, these returns come in 5 to 7 years. this is quite some time to kind of look at the entirety of the life cycle, but having somebody that you can call when you just don't know the answer, having someone who can really help you through your issues and provide more value than just capital, because capital is great, but execution is even better, right? Like dealing with the struggles and hassles of being a founder is a unique complexity, and having a team around you, right? And your investors are actively a part of your team to be able to support you and help you kind of grow and execute. And holistically, right, when it comes to choosing the right partner, again, it really comes back to, do you want active investors or passive investors, right? Active investors might be on your board, and then you need to consider, well, how are they going to provide value to you today, tomorrow, next year, the year following, right? As you continuously grow the business. What does your ownership look like? And this is when we start getting into those conversations on valuation. It becomes particularly difficult, especially in the earlier stages. There's even geographic valuation fluctuations. So if you're in a tier 1 city, Miami in some cases, right, you might find a valuation that's $3 to $5 million higher, purely based off of being in a tier 1 city and access to capital. However, if you go to the Midwest, you go to the East Coast, right, you go to tier 2 cities, you might find your valuation just being $3 million lower, right? And that's just a geographic range that those investors invest in. So keeping those things in consideration, especially if you look to invest and have investors from different geographies, making sure that that balance sits pretty steady and stable across the board, so you can get to a valuation that one makes sense for you. You're not entirely diluting yourself out of your company, right? But whomever gets equity is doing so in a way that is mutually beneficial, but also kind of, commensurate, provides the value long term. Again, looking at that domain expertise, what's the reputation of that fund? How have founders responded to being in that portfolio, right? What do the founders think about those traditionally doing these things on? Is you're trying to do a convertible note, a safe, a kiss? Is this a bridge round? Is this a portion? There's new models of kind of rev share where you can kind of buy back your equity long term. Having these conversations are particularly important, right? And I think one that I forgot to note, which is additively important and is new in this ecosystem, is what's noted as the Reg CF, right? Regulation crowdfunding. And this is additively a unique option that could be a really great partner. Mm-hmm. And crowdfunding, I think, as many know, we're familiar with reward-based crowdfunding, which is known as your Kickstarters and your Indiegogos. There's debt-based crowdfunding in your lending trees. There's donation-based crowdfunding in things like GoFundMe, right? But there's additively equity-based crowdfunding. And this is ultimately just saying you have the opportunity to raise capital from a crowd of individuals. And these people can invest as low as $20, $50, $100, right? But it really spans out the amount of individuals who can invest in your company. If we're in direct to consumer, this works really well for D2C companies. You can have your customers additively be your investors, and they might not buy, they might not support and provide like downstream strategic advice. However, they will champion you, right? They will be repeat customers. You have a significantly larger customer lifetime value, right? They will additively bring in new customers just by nature of word of mouth, right? They'll be excited. You'll have a community around you. So Reg CF is really opening some doors for amazing investment opportunities that doesn't drastically dilute, right? But also goes really well and supplement to other forms of venture capital. So I think taking all of these into consideration is a really great way for you to figure out like what is best suited for you. And then I want to really jump into the anatomy, the best of the best you truly like, and maybe you come up with this target hit list of funds and investors that you want to speak to. You might still get no's, right? And oftentimes, no doesn't really mean not good enough, right? As investors, we have a lot of companies that we really want to invest in, like absolutely love. And particularly, right, for my fund, 75% of our fund is prior founders. We're really empathetic to founders. And the downside is we see a lot of amazing ideas, a lot of amazing founders that we would absolutely love to back, but we do have capital constraints. And it kind of goes back to a number of reasons in which an investor might say no. One being off thesis. Again, Going back to that earlier point of, VCs might see 1,500 deals and 500 of those deals might be off thesis. Well, as VCs and as funds, right, when we're having those conversations with LPs and this ecosystem holistically sells, right? Founders sell to investors that they're the best suited company to generate a return and receive an investment, right? VCs sell to LPs that they're the best fund managers to identify the best opportunities to generate outsized returns long term. Well, we do this under theses. Some funds are specialized. Some funds only invest in women founders, right? I.e., the Females Founders Fund. Some funds only invest in Canadian founders or founders from non-major cities or markets, right? Or founders in ed tech or fintech, whatever be the case. And traditionally, investors have roughly 5% of their portfolio to be able to invest off thesis, but they have to do so really strategically because, again, when it comes to kind of the end of that fund's life cycle, and traditionally, you might have 3 to 4 year active investing periods, you have to go back to your LPs and defend the decisions that you made to be able to raise that next fund. So being off thesis is oftentimes the reason why some investors just have to say no matter how amazing that it might be. And in those cases, you might find that they make connections to another fund that you're in their thesis. And hopefully, right, that kind of becomes the model there, right? On the second note, you have communication, right? I think this entire ecosystem is storytelling. And sometimes when you're locked in and your only opportunity, whether it be when you present your pitch deck via email and your pitch deck is now going up against the 10 to 15 other pitch decks before and after that investor might see, right? You have to communicate the value proposition in your pitch deck. And why? Right, to really the strength, and it's going back to all the points that Aashner noted earlier, right? To strengthen your team, the market opportunity, the traction that you've generated, right? How big is this problem? How aggressively do consumers want to have this problem solved, quite honestly? And why are you, right, the best fit for that? If you can't concisely express that story and miscommunicate in some way, shape, or form, investors might not get it. And they might say, think of it in a statistical way, right? A meaningful sample size is of 30, right? If you have one investor who says like, hey, I don't think this is an opportunity. Unfortunately, I don't see how large this could be. I don't think the market wants this solution. That's one investor kept in consideration. The founders are the domain experts. You know your market, you know your ecosystem as well. And if an investor doesn't get it, it's okay. And I think that's just something that's just really, really tough going through as a founder. It's a really hard thing to do, right? To get told no and no and no again and again and again. But there's a number of reasons for it. But if 30 investors say, hey, I think that X, Y, and Z is a red flag, it doesn't mean X, Y, Z is necessarily a red flag. It might be. However, it could also be that you're miscommunicating whatever that X, Y, Z is, and you might need to shift that means of storytelling, right? So those things are kept in consideration. You go back to stage, additively, we're pre-seed investors. We see a lot of seed stage deals. We see a lot of Series A deals that just get passed our way. And unfortunately, almost immediately, if it's outside of stage, then we can't really invest in it. Because again, right, a part of that thesis is being, and like I said, this is specific for each fund. And I think it's really important to kind of do the overview on the funds. Traditionally on fund websites, you'll at least have your investment scope, the stage that they invest in, the things that they look for out of founders that they're interested in investing in, or they want to meet with. Perfectly fine, right? And again, if it's outside of stage and you're a company that maybe has $6 million in revenue, but you're raising your first institutional round and you're calling it a pre-seed raise, it might not necessarily be pre-seed, right? This is probably closer to seed. This is probably getting closer towards that Series A, right? Or that bridge between the two, right? But kind of depending upon where you are, how you scope the market, whether you're looking for scale, if you found product market fit, right? Those things are kept in considerations, and investors have to invest kind of where they do. Mm-hmm. So identifying the right funds there, right, additively important. And I think looking at that last piece is the strategic side. If a strategic investor declines, right, is definitely might not be directly relevant, right, to that business unit. There's a number of reasons in which why that might occur. And again, perfectly fine. And I think kind of holistically, right, like each of these kind of contribute to each other, and noting that no doesn't necessarily mean it's your fault. right? And that's okay. So I always continuously encourage you to do as much research on the funds in which you're happy and excited about wanting to have invest in you, the funds that you truly align with and would love to build relationships with over time, and identify the best investors for you across the board. And as founders, it's adamantly being strategic about whom you select. As investors, being strategic about whom they select. But it's a long, arduous process from time to time. But I think it's something that is absolutely critical. And with that, to kind of extend ourselves as resources anywhere possible. I know for myself at least, always happy to connect. I don't know if the chat had any additional questions, but happy to answer those if any.
We do have a great question. Curiosity about what books, newsletters, conferences, just sources of information you would recommend for folks who are maybe going on that path to pitching.
Got it. Yeah, no. So I think one, I can actually pass on a resource to all attendees that kind of gives a really good overview of a lot of the, like your founder pitching toolkit, essentially, that shares a lot of resources there. I think kind of being privy to what's happening in the ecosystem, your tech crunches, your startup digest, things of that nature are always helpful. But trying to kind of figure out more in this space, I know for us, Republic has a lot of overview classes on free, right, resources on helping founders best prepare for this space, and understand kind of what the dynamics are of the venture ecosystem. So I'm always really bullish there. I think the resources you go to are going to be, dependent as well upon the region in which you're in. I don't know if everybody here is US based or internationally based, but I know there's a number of entities out there that are supporting founders in that means. So let's see. And Aashner, I want to see if you have any resources in particular, because I know a lot I'd love to just pass on that have toolkits for each of these specifics, because there's a lot of different things that you should probably look up to be privy to the ecosystem. And it's hard to kind of consolidate all.
I think one resource that I would recommend to all founders is Techstars runs an online course 3 times a year for free called Venture Deals, where you go through the process of pitching, negotiating, and understanding all the mechanics in the background of what an early stage venture deal would look like. And you do it paired in groups that are usually other founders and venture capitalists. So it's a great way to build your network while learning about, the ABCs of venture together.
Great resource. And actually, I put this down so I can see as well. Yeah. All right, let's see. Go to.
Are there any other questions that anyone has while we're still up here? I know that the next talk is popping up in 10 minutes or so.
I also had a question, selfishly. As we all know about, well, not all of us, but it's kind of common knowledge that it's harder to get funding statistically if you're an ethnic founder. I think the number is around 1% of Black founders receive venture capital funding. So I know, of course, there are systematic discussions that we can have that aren't as much in our control. And then I say our as in VC professionals and founders respectively. Yeah. What actions do you think Black founders, aspiring founders in this, aspiring investing seeking founders in this chat can do to help increase this number? What are some of the larger pitfalls you see uniquely with ethnic founders?
So I think one thing I would quickly say is, and it's unfortunate, and one of the reasons why I decided to run Startup Boost in Toronto is that you see that folks who know other people who've successfully gone through the process are more likely to get funding. And that crowd is predominantly folks who maybe don't look like us, maybe folks who look more like Stanford bros. And it really helps to be able to have those insider resources and connections that might be hyper specific to the region where you're looking to raise capital in. So when you look online for resources, oftentimes it's geared towards raising funds in the Valley, but that's not the reality for most founders. And that's why I think it's really helpful to look for programs like Startup Boost that offer access to connections and resources for free, predominantly for under-resourced founders that are hyper-local. There's all sorts of hyper-local programs and resources that are available to founders if you just Google, and I would definitely recommend getting involved in those. I know in Toronto, there's a number of them that are very favorable to and are trying actively to help founders who don't have those connections and resources. So that's a great place to be. And then the other thing I would think about is looking for targeted funders or investors that are specifically focused on lifting up people who maybe don't fit into that necessary mold. These are folks who are going to be champions for underrepresented founders as they go through their journeys, and will be able to vouch for you and have a broader network of funders in later stages as well. So I definitely reach out to those people too. It's definitely unfortunate that there's very little. Go ahead.
Oh, apologies. Yeah, no, my screen froze a little bit. And I would add on top of that, right? So to the point of meeting investors who are really passionate about investing in diverse founders, right? Because it has to be something that's really intentional. And, you know, we're seeing a lot of like quota in investing in diverse founders, right? You know, diverse founders holistically have one of the most drastic uphill battles, in particular Black women. However, all the data shows when you give capital to Black women founders, they actually outperform everybody else who has comparable capital. And a huge thing that we're trying to shift, right, is on the other side of the ecosystem, we need more diverse investors who are willing to kind of take the chance on, and not even take the chance, right, but see the opportunity in diverse founders additively, because it's there, right, and it's very much so clear. But I think something that is really great, you know, there's organizations like my own and Score3 Ventures, we help diverse founders raise capital, and then you can literally go to score3.vc and tap in. You have ecosystems across the board of Black VC, HBCU VC. You have the Afrotech, right? And in community holistically, I think is actually really great in kind of getting engaged in those communities. But even just, I think it was 2 days ago, TechCrunch released 51 investors who are focused on investing in diverse founders. Yeah. Tap into those people, right? And, you know, additively, our fund and you know, our GP, McKeever Conwell, is on there as well. And you know, our team is there. But I think the thing is, like, start having a lot of these conversations and work into that ecosystem. Because for a lot of us, we're really open because we get this. And that's why I'm ever so passionate about having these conversations, democratizing access to this information, helping you know as much as you possibly can to raise in this space, because there's so many barriers. If I can remove any of those, happy to do so. And a lot of us here whom are really focused on diverse founders or whom really understand that perspective, we're very much so intentional about doing that. So I would strongly encourage kind of tapping in there. And I think something that often is overshadowed is the power of Twitter, right? And it's weird, right? VC Twitter is its own VC university. It's a far better connector than LinkedIn. I absolutely guarantee. Absolutely guarantee it. And I think that's the upside there. There's so much that's going on. Following the key players in the ecosystem. I know one in particular, right, that I absolutely love is Lolita Taub, that you can follow on Twitter. And she's always giving out all the gems for founders, like literally VC University. She's teaching everything along the way. And it's really focused on democratizing access to a lot of that information. So I think there's a lot of people in this ecosystem who are absolutely phenomenal at doing just that. And I would encourage you to tap in on that side so we can be as helpful as possible.
Sorry, you did cut off a little bit there at the end.
Yeah, so if I cut up at the end, yeah. So I would definitely encourage to engage with the individuals in this ecosystem, because again, we would love to speak to you, right? That's something that we're very intentional about. And I open myself up as well, right? You know, please feel free to reach out to me. You can email me at ap@score3.org. Happy to always have a conversation and engage and kind of teach and democratize access to a lot of that information and be a resource as much as I possibly can. But again, I think for diverse founders, we have to, more than any other, build community and continuously support one another, which we strongly do. This year, there's been an emergence of initiatives focused on diverse founders, diverse investors, right? Diverse everything in this ecosystem. Some is diversity theater, as we know. Others is additively like actually trying to create an equitable venture ecosystem. And there is a long way to go, a very long way to go. Venture's been around for, in technicality, like 80 years at this point in time, right? Only 200 Black women founders have actually raised over $1 million in venture, right? And over the last decade, Black and Latino founders haven't even raised 1% of all the venture that's been deployed, right, in the entire ecosystem. There is a very long way to go. But building community around each other is actually a really great way to do so. So feel free to reach out to me and I'll be happy to tap you in wherever I can.
And then one thing I would just add to that is, you know, as Amani mentioned, that I know that there's a lot of initiatives that are happening right now to support founders. And some of it might look like theater. So it becomes even more important to really ask those hard questions when you're looking at your investors around what value are they going to bring to the table, because venture capital is the most expensive capital period that you can have on your balance sheet. And there's a lot of different ways to get funding. So make sure that if they want to invest in you, they have an action plan, they have key items that they want to bring to the table once you're closing, to make sure that they're actually there to bring value to you as the founder as well. Any other questions while we're still all up here?
That it can be a bit intimidating to speak about something like venture capital, but I want the attendants to know, like, this is a safe space. Ask those questions that you feel are silly questions. I think everyone who's an audience has been in or is in the same boat as you, so feel free to take advantage of that opportunity to just ask anything that's on your mind.
Yeah, there aren't too many of us here anyway, so
yes.
It'll stay between us.
And like I said, if nothing comes up now, again, feel free to reach out. Always open to have these conversations. Like I said, no question is a bad question. Mm-hmm. And ultimately, like, learning the venture ecosystem is tough. Yeah. It's not like any other space, right? Like, the knowledge here is very much so siloed intentionally. It is hard to know everything that's going on. So definitely feel free to ask anything that comes across your mind. And again, I'm keeping myself open. You can follow me on Twitter at Amani Malk. AMANIMALC, and happy to always engage. I'm always kind of cold outreach friendly, and then additively via email, ap@score3.org.
My Twitter is my first name, S, last name, so Aashner Kumar. And then my email is first name dot last name @generationventures.com. And I'm also assuming that Text Giving will give out all our contact info afterwards to folks who are interested. So please feel free to get in touch with us one-on-one anytime. We'd be happy to help you on your journeys wherever you are in them. And we look forward to finding opportunities for us to collaborate in the future. We just thank you for taking the time to hear our perspectives today. And thanks to Nafisa and the whole Text Giving team for putting this together.
Certainly. And I 100% echo that. Thank you so much for each of you taking your time to be here. Nafisa and team, thank you as well. Aashner, thank you for co-leading this. And yeah, definitely happy to be a resource, but we hope that there are some things taken away here, and we look forward to engaging in the future.
Okay. Thanks, Bob.
Take care.